This is TreppWire Week in Review for week ending May 13th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, President Biden says fighting inflation is his top domestic priority. And for investors, the inflation gauges were the numbers to watch. Both consumer and wholesale inflation numbers released slowed last month, but remained much higher than expected. Manus, the markets definitely reacted this week, and we even saw a panic in the crypto market.
It really seems like a lot of things are converging at once in a way that is really pulling the rug out from under any confidence investors have in the market, traders have in the market, retail investors have. The sentiment is incredibly bearish. The markets today, Thursday, May 12th, appeared to be headed for another plummeting, although in the last hour we saw a rally which left the markets mixed. But the tone is decidedly bearish, and I would say for good reason, right? CPI, like you said, slowed modestly, but still above every analyst's expectations. I think Donut Shorts pointed this out via Twitter. The actual print came in above the expectations of all 28 Wall Street analysts this month. PPI last month was revised higher from 11.2 to 11.5. And while the April number dipped slightly, it was still well above expectations. So that's headwind number one that is hitting the market. Headwind number two, and we'll talk about this a little bit later in regard to one of our speakers at a client symposium we had today, is, there's no stimulus taking place right now, right? People are not as flush as they were 2 years ago when people were getting checks. Number three is interest rates are higher, right? So number one, if you're looking to buy a house, you're paying more for that house. If you have a house that you thought was worth $600,000 6 months ago, maybe on its way to $700,000, now that's either leveled off or fallen lower. And then you have the entire wealth effect among consumers, which when crypto is down and stocks are down and housing prices are leveling off and everything you're paying for is higher, from food to rent to gas, it's hard to be bullish under any circumstances. And I think it's hard to see anything in the near term, aside from perhaps a ceasefire in Ukraine, that helps people get more positive about the current situation.
Yeah, I think you're right, Manus. We talked maybe about a month ago about consumer sentiment and that we hadn't really seen a shift in the sentiment. And I think at this point, everything you just outlined, there's really no reason for there to be positive sentiment. I mean, everything seems to be piling on. Inflation is now the number one priority. A few weeks ago, it was releasing oil from the strategic reserve, a bunch of things coming at once. I think if you look at the, just to give some context to the CPI numbers, I think it's 8.3% in April over last year. And the consensus, they were expecting 8.1%. So as you mentioned, it was higher than what was expected. And again, it's not just one thing. You're looking at gas, housing, other goods and services, groceries. I mean, I think all of us have felt the pain. It's interesting, a half dozen Federal Reserve officials, were scheduled to speak ahead of Wednesday's April inflation data. I think Atlanta Fed, President Raphael Bostic outlined his expectations for 2 or 3 more half percentage point, interest rate increases, which is not great news for the market. However, he did suggest he doesn't think there needs to be bigger moves. And then something else that Martha mentioned on the lead-in, there's about $200 billion erased from the crypto market in a day as sell-off intensifies. The price of Bitcoin plunged below 26,000 on Thursday. That's the lowest level in the last 16 months. And then Ether, the second biggest digital currency, was below 2,000 per coin. And then I think stablecoin had a collapse, which has created fears to the broader market contagion potential. So investors are fleeing from cryptocurrencies, stock markets plunging. There's just a lot of things. I don't know where the safe haven is. Inflation continues to just beat everyone over the head. I'm not even sure if a ceasefire would be enough to move the needle at this point.
Yeah, I think you're right. I'm not sure if it would move the needle in the financial markets, although it probably would make people feel a little bit better about safety around the world. We've talked in the past, and we talked earlier today about the wealth effect, that it does impact consumers. It's something the Fed has talked about for 2 decades, that when your portfolio is down, you're likely to spend less money on vacations, on food, on restaurants, and so forth. But very little has been spent on the wealth effect of companies. You don't hear that very much right now. But when you look at what's happening in the broader markets, you're getting a sense that some of this euphoria that surrounded either unicorns or FANG stocks over the last 5 to 10 years is petering out. And we'll talk a little bit more about that, how it affects the office market. But look at some of these numbers that, have hit us, over the last couple of months. Disney now down 50% from its high. Peloton down 90% from its high. Beyond Meat now is burning cash so fast that people are talking about, how much longer before it has to raise capital. It too is down 90% from its cap. And I bring up this point, and I'll throw in a few more. Facebook talking about cutting costs. Amazon talking about being over warehoused. Twitter, it came out today, rescinding offers, not just saying we're going to limit our hiring going forth. They actually said in an internal memo, we're going to rescind hires because we want to put a cap on our spending. PayPal turning to permanently working from home, and Uber saying they're going to start treating their workers as though having a job is a privilege, not a right, which is a little bit ominous there. So when you put this all together, to me, it sounds like a wealth effect of big and small in the tech space of people saying, we don't know where this market is going, and it's time to tap the brakes on spending on offices, spending on warehouses, spending on employees. And that too could ultimately turn into a big headwind for this market down the road.
That's a good lead in, by the way, to talking about one of the speakers we had at our client symposium today. And it's something we've done for the last, well, I was going to say 7 years, but in truth, we didn't do it for 2 years during the pandemic. We used to do it annually. And it was typically targeted to our CRE lender population that were clients. We had about 30 of them attending today, banks, mortgage REITs, insurance companies, and the like. And we had Brian Bailey, who's a senior financial policy advisor for the Atlanta Fed. We asked him specifically about inflation and what his thoughts were about, are we at a point of inflection? And Brian did stress that this was his opinion and not necessarily the Fed's position.
I think it's an interesting question because there are many factors that have an influence on that. So to be honest, we continue to monitor that situation. We're doing what we can by raising rates to try to begin to tap that down somewhat to control pricing, as is our mandate. But certainly I think that there are inputs on that front that are beyond our control. You look at the price of oil, obviously heavily dependent on, the tragedy that is unfolding in Eastern Europe today and other things. Price of food certainly is in that as well. So I think that there are some dynamics that are beyond our control. Certainly good news, though, in that PCE appears to slow. CPI pulled back just a hair, saw a pullback in energy prices. So certainly some good omens there. At the same point, we need to continue to watch it because, as we know, there may be housing prices, there may be, an increase in housing costs associated with rent, housing prices there, as that is still a robust area.
The other thing we asked him about was issues of affordability and whether we're seeing a change in consumer spending.
And affordability, I think right now you look at the dynamics of the consumer. So we've seen 2 years, 18 months of pretty sizable rent increases in the multifamily as well as the single family space. So that is, continuing to make that piece of housing less affordable. We were already in a less affordable environment to begin with, and now all of a sudden you've seen the pop on the 30-year fixed rate mortgage, where it's gone up 200 or 250 basis points just in the last several months. Certainly that is adding to the lack of affordability. So we continue to remain challenged there. I think that, we're seeing a pullback in buyers, certainly putting more pressure on first-time buyers. Same point, the single family for rent crowd continues to buy homes. There continues to be low supply. So it is a situation that we need to continue to watch, continue to try to figure out, because we're not, at the end of the day, we're not building enough units to keep up with demand.
And we've seen, in spite of inflation in the last year, consumers are still spending.
That's right.
Will they stop spending, or at least slow down their spending, or at least be choosier about the things they spend on?
Certainly you look at increased housing costs, you look at inflation having to taking a bigger chunk out of their bottom line, and now all of a sudden, with the increase in interest rates, that obviously has to translate into higher credit card costs. So, kind of a triple whammy there. We do see the consumer using more credit card debt right now. We've seen increases in credit card debt. We've also seen increases in credit card delinquencies, both of which we've seen at points in history. Certainly I'm not saying that it's an omen of a downturn, but certainly there is a correlation, and we continue to watch that dynamic. One of the questions that's been asked a lot is, with the amount of support, the PPP money specifically, that was pushed to consumers during COVID, when would that run out? I think that this is an omen that, between savings rates coming down and folks having to borrow more on their credit cards, it's probably, an indicator that PPP money is running out pretty quickly.
Yeah, it was interesting, Martha, Brian's take on affordability and some of the challenges that we're facing now. And I think it ties in really great with what Manus was saying in terms of, we're seeing it in the private sector on the business side of these companies laying people off and cutting costs. And now we're starting to see it on the consumer side, where they're having to make decisions on what they pay. Utility and usage of credit cards and other type of short-term financing is on the rise. And I think that's just indicative of the pressures that they're facing, from day-to-day living. When you used to be able to fill up your car for $40 and now it's $100 plus each time, those things, the money hasn't increased at that level, at least at the consumer household level. And so they're having to make tough decisions. And I did see something else this week where on the service, transportation services, it showed airfare had increased like 33% from last year. That was according to the Bureau of Labor Statistics. So it just shows it's pretty much across the spectrum, whether it's consumer travel in their vehicle, whether it's airfare, whether it's rent and affordability. We're starting to see some of those downward pressures with people having to make decisions on what bills to pay first and potentially not paying some of them. And it'll be interesting to see how quickly maybe that spreads to the broader income stratas.
Well, tomorrow we have a consumer confidence number coming out. It'll be interesting to see if that's reflective of American consumer concerns at this point. But it brings up something that I don't mean to make light of, a situation where people are spending a lot more money and people are choosing between food and gas and things like that. But I do find myself in moments like this, when there's increased volatility, I have my own consumer confidence index, and that is how much I turn on Bloomberg at night at 10:30, right? Normally I'm a guy looking for Roadhouse or the Terminator or maybe a Western Conference hockey playoff game. And now, I've become very used to putting on Haslinda Amin from Singapore. I think she's on from 10 p.m. until midnight on Bloomberg. And I was thinking that Bloomberg should offer up the Haslinda Amin index, which shows, how many people are watching her just like me to see where the 10-year treasury is and where stock futures are, instead of watching Patrick Swayze and Sam Elliott in Roadhouse.
I'm seeing a shout out in our future from her.
I wish I could remember the others that are on there. I can't remember her two co-hosts, but there is a guy who comes on after them. He's not on often, but I think it's Manus Cagney.
No.
So I'm not lying. Manus
That's
Cagney of Bloomberg, he comes on after midnight. He's like the Wolfman Jack of Bloomberg coming on after the midnight hour.
so a couple other points. We also had Mike Flood speak. He's from MBA. He's a senior vice president of their commercial multifamily policy and member engagement. And the things he's watching and what he spoke to our group about was regulation. And while elections are on the horizon-ish in the next 6 months or so, he doesn't think that the elections will tip the balance one way or the other, that right now the issue is regulators. And as you saw today, Powell was confirmed to his second term, so we won't see a lot of change there. And President Biden has nominated Michael Barr, who is for the Treasury Department, and he's the architect of the Dodd-Frank regulatory overhaul. And it was interesting to hear that apparently not all the Dodd-Frank regulations had been implemented.
Elections do matter, but at the end of the day, we're all going to be paying attention to the regulators. So regardless of who wins Congress, be it a split Congress, full Republican or full Democrat, the regulators don't change. The president picks the regulators. So those agendas will remain static. And so I think we spend a lot less time looking at Congress and a lot more time looking at the regulators over the next 2 years.
Yeah, that was the one thing that I thought was interesting is Mike mentioned, maybe there's some life left in the Dodd-Frank, and there's some things stragglers that have not been enforced or put into place at this point, and they may be resurrected here. So regulations seem to be the theme. I think he did a really good job of just walking through how that process plays out. And, if things don't get passed at a federal level, that we're seeing an increase at the state and local level of regulations imposed, whether it be rent controls or environmental testing for new loans or whatever the case may be. I will say Mike is a very talented speaker, and Brian was too. We had some really great speakers at the symposium today. It was really an interesting time for all of us to come in and learn. So, some good takeaways. And I think it'll be interesting to see on multifamily specifically. It seems like maybe regulation's the only thing that stops that train, because it seems like rent growth and everything else that we've talked about has been really, really strong and continues to be. But if owners or lenders have to require additional due diligence in the form of, I think Mike mentioned radon testing and some other things that were more stringent. And on HUD financing, he said there was like an 8-month wait list to even get somebody appointed to that file. Those regulatory stipulations could really slow the market down if they started taking hold.
Yeah, I would tend to agree with Mike that so much of what happens in the world happens behind closed doors at the regulators. If there's one thing that might move the needle, would be if there was meaningful effort to cut federal spending, stop the train of trillion and $2 trillion and $3 trillion deficits. That might help get inflation under control and put a lid on where interest rates ultimately get to. I'm not sure the legislative bodies in this country have the appetite to do that, but that's really the only place I think that they can move the needle in any meaningful way.
And a couple other points. We did a sentiment survey of our population that was at the event and asked them a bunch of questions. A couple that I thought we would call out. One was, will the Fed policy trigger a recession? The interesting takeaway was how evenly split the decision was across the answers. So as many people answered highly likely, not likely, and there are too many uncertainties to say for sure, which I think is a little bit of a reflection, while not statistically a meaningfully large number of people that we polled, does seem to reflect how people are feeling.
Well, it is somewhat deterministic, right? That if the Fed overshoots and it hits the market with 4 or 5 or 6 50 basis point hikes, it's almost assured to trigger a recession. What the audience didn't know is, will they do that, or will they stop at 250s or 50 and 325s, right? That's why there's so much uncertainty at this point. We just don't know. We know how hawkish they're talking. We just don't know how hawkish they will be ultimately. And that is really the blind spot among investors right now. If they're too aggressive, I think it's almost unavoidable that they will trigger a recession. If they're not nearly aggressive enough, I think we'll see runaway inflation. So I think time will tell, and it's very hard to know which way this falls.
It seemed like the interaction between the participants, though, when Brian was talking and some others, you definitely have people that are in both camps. You have some that would probably argue that we may be already in a recession. You would have others that feel like there's potential to stave it off. And I think some of that maybe is tied to the property sector in which they follow most closely, or maybe geographic regions that they're located in, or maybe they're not feeling the effects of some of these challenges at the same level as everyone else. I mean, the inflation is universal, but some of these markets still appear to be doing very, very well relative to others.
And just to round out our conversation on that symposium, we asked them the question, which property sectors are you most interested in for underwriting? And the answer was hands down industrial, and least interested, the answers were office and retail, which is a good lead in for us to start talking about the different property sector stories we've seen this week, starting with office.
Yeah, I think that sticking with the decidedly bearish opening that we talked about, all the headwinds that retail investors are facing, consumers are facing, businesses are facing, there was an awful lot of negative headlines that kind of walloped the market this week, or it didn't wallop the market. We didn't see spreads blow out. We didn't see default levels rise, right? We've said for a long time that the office story will take years to play out because of the long-term nature of leases that are out there. But headlines can change sentiment. And the headlines we saw this week were really, really kind of over the top negative. I'll start with the Wall Street Journal. This was a piece on Wednesday, I believe. You kind of can't come up with a more negative headline. Office building owners drown in tide of sublease space. I think that piece came from Conrad Pulitzer, if I'm not mistaken. It goes on to say companies throughout the U.S. are flooding the market with office space they want to sublease, aggravating landlords already facing weak demand. That's the lead sentence there. It sources a CBRE group story, or research piece, which notes that sublease space increased almost 4% in Q1 to 159 million square feet available, below the 2021 peak, but growing. So this is the kind of headline that makes a would-be tenant say, maybe we should shop around more. Maybe we should negotiate more. Maybe the tide is turning in our favor. And when it does, even if in local markets it's not turning in your favor, it does make the would-be tenant ask for more accommodations, right? It makes them more aggressive in the ask. A second one out there, this came, I believe, from Steve Cuozzo of the New York Post. Big New York City office tenants quietly shrink square footage in major reset. Now, most of these stories will not be new to either our listeners or to our TreppWire readers. HSBC shedding about 50% of their space in Manhattan as they move to Hudson Yards. JP Morgan downsizing by about 700,000 square feet between 2021 and 2022. Again, these headlines tend to weigh on the markets. People start to think there's more space out there than I previously thought, and this doesn't benefit landlords at all.
Yeah, I don't know how many weeks in a row we've talked about the right sizing or downsizing of these office tenants. Here's another little anecdote, Manis. The Partnership for New York City conducted a survey where they said just 8% of Manhattan office workers have returned to the office 5 days a week for in-person work. And that was published on May 9th. Of the employees surveyed, 78% indicated they would continue to embrace a hybrid work model, even after the pandemic comes to an end. Just for context, that number was around 6% before the pandemic. So again, with all of the additional pressures that we've talked about here, if you're an employee, your preference at this point probably is to come into the office, just a couple of days a week. And if that's the case, we joked about maybe having a downsize bell or something on the podcast, but at this point, it's significant. Every week, there's some stories about downsizing in major markets. The Wall Street Journal piece was very interesting, but one caveat to that, or one comment. We saw the flip side of this with the meme stocks and going to the moon and all this stuff with positive sentiment and maybe like overly ambitious investors like piling into things. And I think we're seeing the downside of social media, broad media distribution, real-time access to information of these negative headlines having an impact on the marketplace. So I've seen several folks that I follow on Twitter the last week made comments just individually that they're going to unplug for a little bit because, the sentiment has gotten to be too negative and it doesn't help them in their day-to-day business of trying to be real estate practitioners. So just something for us to consider. I think a lot more people are exposed to these stories in ways that in previous downturns, they probably wouldn't have had the data at their fingertips 24 hours a day.
Yeah, I will address one of the negative headlines now that came out this week. There was stuff going around on Twitter. There were a couple of stories out there about the negative return of a CMBS ETF out there talking about, I'm not sure if it said it's at an all-time low or that it had, really fallen off the map and so forth. And some of the statistics and some of these negative headlines I buy into, right? When subleasing space grows, it is a negative story, right? The headline was a little bit over the top, but you can't disagree with the fact that there's a lot of sublet space out there. When you see in New York people taking less space or 8% of the people going to the office, there's no denying, right? That's true. But, and this is something one of our former hosts, Darren King, pointed out to me, that the duration on the ETF, on the CMBS ETF is about 5 years. And what we've seen over the last, year is the yield on the 5-year go from below 1% to above 3% in short order, right? So a huge part of the decline in the value of the CMBS ETF has been because interest rates have gone up. It's not because people are watching spreads blow through the roof, right? Yes, CMBS spreads are wider, but the correlation between the 5-year Treasury and the 5-year CMBS ETF is pretty close. And I would say, and I haven't done the math on this, but I would say that 90% of the price decline that we've seen in the 5-year ETF is due to rising interest rates, and maybe 10% is due to spread widening. So for people that have seen these headlines are thinking commercial real estate is going back to the late 80s or the post-Great Financial Crisis period, we're not there in terms of spread widening. So I just wanted to add that perspective. If you're seeing headlines like that on Zero Hedge or something like that, there's a little nuance to that. People shouldn't read into that we're looking at 2008 spread levels or even March 2020 spread levels. That is not what is happening behind the scenes.
So there were a few other office stories, including, I think you're going to get to some more layoffs that we've seen.
Yeah, I'll start with the crabgrass and I'll go from there. On the crabgrass in San Francisco, Splunk, I'm not even sure what Splunk does, but they have listed their corporate headquarters up for sublease. So it's more of that sublease story. They have 215,000 square feet being made available for subleasing. JLL is handling that engagement. That's a piece of crabgrass there. Elsewhere, Carvana laying off 12% of their employees. It seems to be a lot in their distribution centers and logistics centers. It hasn't been announced anything that's going to touch their Tempe headquarters, which is sizable. People should keep an eye on that. We talked earlier about Uber looking to cut costs. I will leave off with 2 green shoots. Number one, SVP Securities has expanded its lease at 1301 Avenue of the Americas, also known as 6th Avenue in Manhattan. They are going to take an entire new floor, adding 70,000 square feet to their commitment there. So not all news is bad news. And in Maryland, the Department of Human Services is going to move downtown. We've seen a real struggle for downtown Baltimore over the years with some of the financial firms moving out or downsizing away from Class B buildings. I think this is a great precedent that other states should follow, trying to use some of their leasing muscle, if they can, to revitalize struggling downtown areas. If you could see that being done in Illinois, Baltimore, and other places, that would be a great thing. And one mixed green, Boeing announced they're leaving Chicago and moving to Arlington, Virginia. a blow to Chicago, but certainly a green shoot for Arlington.
Yeah, quick question for you, Manis, on Carvana. I think they have about 33 of those car vending machines. Have you seen those?
I have seen those. I mean, how does that work? Is it like buying a, Gatorade after beer league hockey? Do you just go in there and, put in your credit card and out comes a car?
I think
Right?
I think you like buy the car online and they like give you some Chuck E. Cheese type token and you can go put the token in. But if they keep laying people off, like, are there going to be some people trying to office out of the Carvana vending machine? It's an all glass. Everyone gets a window. I don't know what the alternative use for that is.
My use of vending machine kind of caps out. If you remember in New York City, the old automat, where you can go up and you could put in, 75 cents and get a Boston cream pie or a tuna fish sandwich. That's about, where I max out on using a vending machine. That or maybe a Gatorade, or, you get above $2 or $3 and, I'm done. I'm out.
Vending machine tuna fish sandwich. I'm pretty sure the health board wouldn't even allow that.
A couple of years ago, my father told me I only had one regret my entire life. And how great is it? You go through your life, you have one regret. But I was expecting something deep and penetrating and kind of philosophical. And he said his only regret in life was once getting the tuna from Dunkin' Donuts. Can you imagine living a life, 89 years old, and that's your only regret? God bless.
I want to know what the aftermath of that was. So let's go to industrial. We had talked about industrial several times over the course of the last few weeks and year as being everybody's favorite property sector.
Well, I'll throw out a question for Lonnie. I'll throw a few data points out there and I'll follow it up with a question. Because Lonnie, I think, knows the industrial market better than I do. So 3 headlines over the last 10 days. One we talked about last week, Amazon saying they were over warehoused, that they had created 25 years worth of warehouse inventory over the last 2 years. Earlier this week, Prologis bidding almost $24 billion for Duke Real Estate, Duke Industrial, which Duke rejected. They rebuffed the offer. And KKR, which had never built warehouses before, announcing that they were jumping into the warehouse business and they were going to start building properties in that space. So Lonnie, any of these look to you like peak industrial? We know delinquency rates under 1%, values in many markets double or triple over the last couple of years, even in old stodgy areas like cold storage, skyrocketing. Does any of this tell you we're at peak industrial demand or peak industrial value?
Yeah, I think if you just looked at the headlines, you would probably come to that assumption. I think on the Prologis story, Globe Street actually had a story that kind of followed up the announcement of the $23.7 billion proposed deal between them and Duke Realty, where it revealed that Prologis had, basically said that demand for warehouse space due to e-commerce growth and inventory will continue to outpace supply in new construction. So they projected holding industrial vacancy rates in 2022 at a record low of 3.3%. Even in light of Amazon's, revelation that it had too much warehouse space, Prologis still concluded that the industrial market needs about 800 million square foot of new space to cure the current shortage and allow retailers to bring inventories back up to pre-pandemic levels. So I would say Prologis, probably the largest industrial owner operator in the world. They obviously feel like there's upside here. I would say also, just on the macro, it's a lot easier to develop. It's a lot easier to build warehouse and industrial properties than it is any other property type. So generally speaking, they're in lower zoned parts of town. There's less red tape. You don't have neighborhood associations or condo associations fighting your building like you do for multifamily or lodging or other things that are more infill type of developments. And we've seen with the explosion of land prices, especially on residential single family homes and on these larger multifamily deals, that you almost have to build high-end Class A stuff in order to justify to offset the cost of the land. So if you can acquire industrial property land, for KKR in their example of kind of ground up development, at a reasonable price, lower barrier to entry, and you think there's still some pent up demand in the marketplace, I'm still kind of bullish on industrial. I think there's still more to come. I also know, like, I've been in the business 20 years at this point on the CRE side. Industrial was neglected for probably the first 18 of those 20 years of my career, where nobody wanted to work in industrial, when compared to multi or retail or office. The brokers, felt like it was a second tier property type. And we're just now, because of the shift to e-commerce and kind of last mile distribution, seeing it have its glory days. So I think we're getting close, but I think there's probably still a little bit of, green space for them to capitalize on here over the next couple of years.
I'm not ready to call a top on the industrial market, and I'm far from calling a bear market on this market. I think, it does have room to run, but I do think that we're getting close. And just like I've said in the past, with retail and store closings, if you didn't close your store over the last 2 years, if you endured COVID, chances are you like the store and you're going to keep that store. And what makes me a little bit nervous about industrial at this point is if you haven't figured out your e-commerce strategy, if you haven't loaded up on distribution and warehouse yet, chances are you're not going to get there, right? We've seen huge strides from anywhere from Macy's to Target to Walmart and everywhere in between. And if you haven't figured it out yet, I just don't think that there's that many big players out there with enormous demand that can keep this going much more than a couple more years, right? You failed if you haven't put the things in place between 2020 and 2022 to make this happen. It's not going to happen for you.
Yeah, I would agree with that sentiment. I think one thing that's interesting in this discussion is industrial has seen its rise to glory here when the supply chain's been broken. If supply and demand kind of hit equilibrium and we kind of get things ironed out, like potentially there is significant pent up demand because people are actually going to be able to supply their warehouses. Something for us just to look at. Blackstone, we talked about them the last couple of weeks, buying publicly traded, REITs, the American Campus Communities and PS Business Parks. Prologis is similar in this instance, where they're basically offering about a 30% premium to the share price as of Monday's close for Duke Realty. So that indicates that they feel like even at a 30% premium, they're buying at least scale in the market, and they're buying, those buildings at a price that they couldn't go achieve if they were to do it themselves. I mean, Prologis probably has the best in class logistics, site selection, type of infrastructure. And if they feel like even paying 30% premium to acquire this is still valuable for them and there's upside, I think it just bodes pretty well for that strategy of industrial having some runway. Yeah, just going back to the KKR story, man, I could view that as a sign that we're nearing the top. Since this is their first venture into like ground up development, you kind of know when you're at the top when people that aren't used to investing in certain sectors start making big pushes into those sectors. And this may be kind of a signal that while KKR is capitalized and they've done well, like the fact that they're just now jumping on the bandwagon for industrial development maybe is another sign that they were reaching close to the top.
Yeah, I think that anytime you see tourists entering a market, it's time to get concerned. I wish I had told people this, especially the crypto bros, 6 months ago, that I bought a small portion of Coinbase, thinking, well, I'm not really interested in owning crypto itself, especially if I have to get cold storage and worry about remembering my passwords and so forth and figuring out how to trade this stuff. So I thought, let me take a small position in Coinbase. And, I'm a tourist in that market. And sure enough, it's been a wet bag of cement ever since. So, to tap into Les Nessman and WKRP Cincinnati, back in the day. But yeah, anytime tourists come into the market, you start to think, is this, that Joe Kennedy shoeshine boy moment that we've reached a peak.
Martha, can you envision Manus's mining rig for the crypto? He turns it on, the lights dim in the house, the walls shake a little bit, and then smokes for a second until it starts doing whatever a miner does in the crypto space.
I still use DOS. You know what I mean? That's That's all you need to know. If my firm would let me still use a BlackBerry, I'd still have a BlackBerry. You know,
One with the mainframe.
I want Apple to return the spin bar, you know, on the for the music, right? All these things that I used to love, all gone.
He's a resistor. So on to shout outs. Dan McNamara, who we've had on the podcast some time ago, it might be time to invite him back, commented on Twitter on our story about URW's planned mall sell-off discussion, and shouted at you, Manus, on Twitter, as well as TreppWire.
Yeah, we should get Dan back. You know, there's a lot going on right now, a lot of volatility. Spreads on CMBX 6, BBB minus continue to blow out. A lot of loans remain in purgatory. We should have him back.
And Jane D was wanting to be on our mailing list, and I don't mean snail mail, I mean digital. Carly Tripp, who did a podcast with our team and had a very loyal listener of our podcast, Chris M., that she wanted to give a shout out to. Additionally, someone commented that the podcast was one of the ones they loved, and that was Caroline R. She loved the insights that Carly Tripp offered our group. It was actually Manus and Haley that did that podcast.
Yes, kudos to Haley, who really did a nice job hosting, and it was great having Carly on. She was a terrific guest, and if you haven't listened to it, check it out. She gave us really detailed observations on several different property types and where she thought the markets were going. So I thought it was one of her meatier podcasts.
And Susie S. on LinkedIn, she commented on Manus's ebullient comment. She said, this podcast is brought to you by Manus and the letter E. So she had a little fun with your vocabulary.
Yes,
word.
Jan F. also, he reached out to us about a wreck on a highway in Los Angeles, I believe, where I think it was the thesauruses, it's another long word that I struggle with, were littering some highway. I guess a truck filled with either dictionaries or thesauruses, there we go again, you know, kind of was in a crash and left a litter all over the road out there. We also had reach outs to us from Donut Shorts that I mentioned before. Thank you for all those tips. And also Ginger, who was interested in the single family rental market. So a lot of different reach outs to us this week from different social media.
Yeah, and Black Eagle, who's a frequent commenter on Twitter, commented on one of our recent commentaries about grab and go at Dallas. So we talked about Amazon Go as one of the things and had a little fun with that. So this weekend, guys, I don't know if you're superstitious at all, but you know, tomorrow's Friday the 13th. And of course, this weekend we've got the blood moon, which is kind of a slang for the lunar eclipse that we're having. So I'm going to have a little party and I'm putting together a playlist and wanted to get, Manus, I know you're a song aficionado of many, many types. So thought you'd recommend your favorite song that has moon in the title.
Well, you didn't quite give me the vibe, but if it's like a cheese and wine type thing, I would say Harvest Moon, Neil Young. I would have to say that's Neil Young at his finest. One of my favorite songs of all time. If you're talking about kind of more festive, you know, kind of walk around and really kind of, you know, almost dance, I would say Dancing in the Moonlight by King Harvest.
Ooh, that's a good
And if you really want people to leave early, I would say Moon Dance by Van Morrison, perhaps the most overplayed bad classic
on my
rock
list.
song of all time. It's right up there with Smoke on the Water and the 3-minute version of Light My Fire.
Oh,
Right.
yeah.
The 7-minute version is one of the greatest songs ever. The 3-minute version, one of the worst.
That's funny. Poor Van Morrison. That's not nice. Lonnie, you got one for me?
Well, I just want to say Manus is very well-rounded. I can only be passionate about commercial real estate, and he can really dig in on the music stuff. It's impressive. And he's got a little bit of champagne taste, and I'm more on a beer budget. And it's usually light beer from the tap. So I didn't get one with moon in the name, but sticking true to my R&B roots, there's a song called Regulate by Warren G, Nate Dogg and Warren G. So in the theme of the Mike Flood, Brian Bailey regulatory environment, we're going to go with regulate, where the verse is, "It was a clear black night, a clear white moon."
Oh,
I won't go any farther than that, but that's where I'm at.
going some deep tracks on me. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.